Hey everyone, welcome back to another episode of AWM Insights. I'm your host, Justin Dyer, Chief Investment Officer here at AWM, alongside Mena Hanna, Portfolio Manager. And we're going to jump right in to today's topic, which is the thrilling and enthralling topic of interest rates. And I say that somewhat jokingly. We are going to make this very interesting because it's actually incredibly important. And it really is interesting, especially for us finance nerds. And the simple way to think about this is like it's the lifeblood of financial markets, interest rates. Why are we even talking about this? Well, if you haven't been living under a rock, you probably have seen some headlines around the Fed meeting and even pressure from the president to lower interest rates. It looks like we are finally going to get some decreases in interest rates at the next meeting that the Fed holds in the not too distant future here. And it's a kind of turning of a page or a new chapter where we went from increasing interest rates to really stabilized interest rates for quite a few years, and now we're gonna see an easing cycle start, as they say. A simple kind of analogy here is interest rates really control the speed of play. So just like the speed of play changes when the clock ticks down in a game, interest rates kind of affect how fast money can move throughout the financial markets. And so we're going to kind of get into some impacts, why, what do you need to know, and address a common question when it comes to interest rates. So Mena, take it away.
Yeah, interest rates. All right, where do I start? Over the last few years, we've actually had a pretty interesting swing with interest rates. During the pandemic, you saw the Federal Reserve cut interest rates to zero. Interest rates were held pretty much close to zero until 2022, when they were raised because of inflation. When interest rates actually started going up, you saw the stock market decline. Now, there's a lot of different reasons as to why, but that dynamic actually is usually typically a little bit of what you see. If interest rates are rising, if we're in a rising interest rate environment, stocks tend to perform a little bit worse. Currently, we're in a falling interest rate environment, and that usually leads to stocks and equities doing a little bit better because of the dynamic you were talking about. Speed of play gets a little faster, money is moving a little bit more throughout the entire system, so people are just making more money. So as inflation kind of settles down, as employment also weakens, those are reasons for the Federal Reserve to drop interest rates. We're seeing pretty much 100% chance of a drop at the next meeting in September. And when that happens with a healthy market, a healthy economy, that's usually a good sign for stocks and equities. Now, there's no guarantees. Obviously, we've gone through a very, very interesting last few years, but that's typically what happens. The analogy that I like to use to think about interest rates is when interest rates are more favorable, it's essentially like a team's salary cap. Salary cap goes up, the team has more money to spend, players make more money, everyone's essentially happy, maybe except the team owners who don't want it to.
Hopefully they're winning.
Yeah, hopefully they're winning. And the team owners could be happy. I think what they don't want, and what the Federal Reserve, in this case, the Federal Reserve is like team ownership. They don't want it to get out of hand where way too much money is out there and you're getting crazy inflation in salaries or in dollars, and everyone is essentially hurt. So they want to keep things reasonable. They want to keep things in check, but ideally they do want to stimulate the economy and make sure that there are jobs, there's economic growth, and everyone wins in that scenario.
And inflation is under control, right? So a little bit of the not inside baseball, but kind of the wonkish side of this, the nerdy side of this, is the Fed is controlling two aspects of the economy: inflation and employment. That is their mandate. They look at those two data points in a variety of ways and make sure that those are healthy. Sometimes they contradict each other. Inflation is ticking up a little bit, but the jobs picture is getting worse. And so that the job side is kind of dominating the narrative, or the broader economic picture drawn from what's going on in the labor force is dominating where they're putting time and attention. Like you use the words typical and how markets react, and 100% you're correct. It's also one of those things I want our listeners to take away is like, typical is a strong word here, right? Like, yes, okay, if interest rates go down, the cost of money is essentially going down, and so there's more money, speeds up the pace of the game. But there's also plenty of situations where the economy is not doing very well, and interest rates have to be cut, and markets also decline, and it takes some time for certain things to digest through the financial system, et cetera. So, I mean, we talk about it a ton on this podcast. There's so many variables that go in. It's really, really, really dangerous to just pull simple black and white conclusions. And I just want to underscore that. That's my job here.
Definitely. This is a question I've actually gotten it 3 times in the past week. Interest rates are coming down. Should I refinance my house? What should I actually be doing with some of the debt that I have?
Yeah, great question. My answer, you'd think I'm a lawyer, maybe. It depends. But what I mean by that is when you can't just look at your interest rate and say, okay, interest rates are going from whatever, 6 3/4 to 6.5, or, 6.25. Like, yes, that's a starting point, and you do want to save money. And what your monthly payment ends up being could be cheaper than it is right now. But guess what? When you refinance or you have other debt that you might want to consolidate, there's all sorts of closing costs, et cetera, like fees that just get piled on top of it. And so, yeah, you might be paying a lower monthly payment or financing payment, but if you look at the entire cost of what your debt load will be over the life of it, there's a good chance it actually might be still more expensive than it would be otherwise because of all the other fees that gets tacked on. So, there's general rules of thumb, but very, very specific to each and every client circumstance or under any individual circumstance. Great question to ask, but you can't just blindly do it. Be like, oh, my monthly payment's going from $4,000 to $3,500. I should do it. Well, yeah, if you're solely concerned about cash flow from a month-to-month basis, like, yeah, maybe that is the priority. But if you're thinking about just, and hopefully all the listeners here are able to manage cash flow, so you're thinking about total costs, there's a very good chance refinancing with a small interest rate decline is actually more expensive because of all the fees that are involved with it. So, like anything, it's nuance, right? That's why I said it depends.
Yeah, it's definitely something to walk through with your advisor and try to factor in all of these different pieces of the puzzle and make sure that you are making holistically the right decision.
Yeah. All right. So hopefully we made interest rates somewhat interesting. And in all honesty, all seriousness, it's an incredibly important aspect of financial markets, topic of financial markets. So if you do have any questions, definitely reach out to us. Mena is going to give his phone number again for text messages. But yes, we love the feedback. Throw us ideas. Send us those questions.
Yeah. My number is 626-862-0355.
Cool. All right. We wrapped up a short episode today. Tried to make this digestible, like I've said. Give us your feedback. And until next time, own your wealth, make an impact, and always be a pro.